This podcast is for informational purposes only and does not constitute financial advice. Consult with a qualified professional before making any investment decisions.
Welcome to the Wire Weekly Roundup, the week in real estate presented in digestible bites. Hold on while our AI hosts take us on another ride through this week's top real estate headlines.
Welcome back to The Wire, your weekly deep dive, into all the data and trends, shaping the real estate world. We know you're busy out there hustling, so we've done all the heavy lifting. We've sifted through, the latest reports just for you. Zillow Altos Research, the National Association of Realtors Housing Wire.
Yeah, it's like we brewed you a strong cup of market analysis.
Oh, yeah.
No sugarcoating, just the good stuff to fuel your, real estate brain.
Exactly. And this week, we are tackling the big question that's on everybody's mind. What's the deal with mortgage rates, and what does it all mean for your clients in this crazy, constantly shifting market?
What's fascinating is that amidst all this economic uncertainty, we're seeing this tale of two markets. On the one hand, we've got home prices, they're still inching up, but at the slowest pace in a decade. That 4.5% year-over-year growth that Zillow is reporting is a far cry from those double-digit surges we were seeing just a year ago.
Right. It's like the market's tapping the brakes, but not slamming on them. So is this a true slowdown, or is this just a temporary pause before prices take off again?
Well, that's where things get really interesting. Altos Research points out that inventory is really playing a crucial role here. Nationally, we're still facing a shortage, about 28% more homes on the market than last year, but that's still significantly below pre-pandemic levels. However, they predict that if current trends continue, this inventory shortage could actually vanish by next spring.
Vanish? That's a pretty bold prediction.
Yeah.
What's their reasoning behind that?
They're seeing a couple of factors at play. Firstly, the pace of new listings. It's increasing, which is adding to that overall supply. Secondly, some markets, especially those in the Sun Belt like Texas and Florida, are extremely sensitive to those mortgage rate fluctuations. When rates spiked last year, their inventory surged as those buyers kind of pulled back. Now, with rates dipping a little bit, those markets are seeing less of an impact. But nationally, that trend of increased inventory is continuing.
So basically, those once hot Sunbelt markets are now acting as a sort of bellwether for inventory trends.
Exactly. And this brings us to another intriguing point from Altos Research. If mortgage rates were to drop back down towards 6%, we could actually see a reversal in both inventory and price trends. Imagine that. Lower rates spark this new wave of demand, further depleting inventory and potentially pushing prices right back up.
Hold on. Are we talking about a potential return to a seller's market even with those higher home prices?
It's certainly a possibility, and one that few are talking about. It really highlights that fragility of this market and how sensitive it is to even small shifts in interest rates.
It's like a high wire act with buyers and sellers, carefully balancing their hopes and anxieties on this ever-shifting rope. Speaking of rates, let's dive into the mortgage rate mystery. We've seen this recent dip with the 30-year fixed rate, now down to 6.76%, according to Housing Wire. What's driving this decline, and is it a sign of things to come?
Housing Wire attributes this dip to economic uncertainty. Investors, they get spooked by market volatility, and they seek that relative safety of bonds pushing down yields. And as we know, mortgage rates tend to follow those bond yield trends.
So fear is actually making mortgages cheaper. That's a little ironic, isn't it?
It is. But here's the catch. Housing Wire cautions that it's too early to celebrate. Factors like, stubborn inflation, a sudden shift in investor sentiment, or a surprise rebound in economic activity. Those could easily send rates climbing again.
Yeah, it's like trying to predict the weather in a hurricane season. You just never know what's going to hit next. But before we get swept away in this storm of uncertainty, let's talk about something that could potentially bring some sunshine to the affordability picture. Mortgage spreads. What are they, and why should our listeners care?
Mortgage spreads are basically the difference between mortgage rates and the yield on 10-year Treasury notes. Now, what's interesting is that these spreads have been unusually high in recent years, meaning that mortgage rates have been higher than they quote-unquote should be based on those bond yields.
Okay, I'm following so far. So if these spreads were to shrink back to their historical norms, wouldn't that mean even lower mortgage rates?
Precisely. Housing Wire suggests that rates could be nearly a full percentage point lower if spreads return to normal levels. Now imagine what that would do for affordability. Suddenly those higher home prices might not seem so daunting to buyers.
That's a huge difference. But is there any indication that these spreads are actually starting to narrow?
It's hard to say for sure, but there are some subtle hints. It all comes down to, the overall economic climate, investor confidence, and lending practices. If things start to feel more stable and predictable, we might see those spreads shrink, creating some much-needed relief for borrowers.
So it's like a waiting game, but with potentially huge rewards for those who are patient and prepared. But let's not forget the elephant in the room, affordability. Even if rates drop, those record-high home prices are still a major hurdle for many buyers.
Absolutely. The MBA's Purchase Applications Payment Index paints a pretty sobering picture. The median monthly mortgage payment has now climbed to over $2,200. And remember, that's with rates already on the decline.
Ouch. That's a serious chunk of change, especially considering that wages haven't kept pace with those rising housing costs. Are there any bright spots out there? Any signs of hope for buyers who are feeling squeezed?
Actually, there is one area where we're seeing some creative solutions emerging: new construction. It's currently making up a higher percentage of the market than in recent years, about 14.5% according to Realtor.com. And builders are getting strategic with incentives to entice buyers.
Yeah, that's what I like to hear. Builders to the rescue. Tell me more about these incentives. What are they doing to make new homes more appealing?
They're offering things like mortgage rate buydowns, closing cost assistance, design credits, and even price reductions in some cases. They're essentially trying to bridge that affordability gap and make those new homes more accessible to a wider range of buyers.
Okay, that's definitely good news for buyers. But what does this mean for our listeners? The real estate professionals who are guiding clients through this complex market, are there any specific takeaways they can apply to their businesses?
Absolutely. For agents working with buyers, it's crucial to understand the nuances of the new construction market and be able to educate clients on the various incentives and options available.
So basically, agents need to become experts in new construction to effectively guide their buyers through the process. That includes understanding the different builders, communities, financing options, and of course, those all-important incentives.
Precisely. And don't underestimate the power of building relationships with builders and their sales teams. Those connections can be invaluable when it comes to accessing inventory, getting the inside scoop on upcoming developments, and advocating for your clients' needs.
This is all great information. I'm already feeling more informed and, dare I say, a little more hopeful about the future of the market. But we've covered a lot of ground in this first part of our deep dive. And there's still so much more to discuss. Stay tuned. Because in part 2, we'll be exploring those new construction trends in more detail and examining the factors that could make or break the market in the coming months.
We'll also delve into the potential impact of policy changes, economic uncertainty, and of course, those ever-elusive mortgage rates. Buckle up, folks, because this ride is far from over.
Welcome back to The Wire. In part 1, we laid the groundwork. We, explored the current state of the housing market. Now let's dive a little deeper into this new construction boom and see what's really driving it.
Yes, because it seems like builders are becoming like the MVPs of this market, stepping up with innovative solutions to address that affordability challenge. Last time, we touched on the fact that they're offering all sorts of incentives to entice buyers. Let's unpack those a little bit and see how they're playing out in the real world. What's fascinating here is that builders are getting really creative with their offerings, tailoring them to the specific needs and concerns of, today's buyers. For example, mortgage rate buydowns have become increasingly popular, especially with rates still hovering above 6%.
Right. We talked about those briefly in the last segment. Can you remind our listeners how those buydowns work and why they're so effective in this current environment?
Absolutely. A mortgage rate buydown is essentially a way for buyers to, temporarily reduce their interest rate, which of course translates to lower monthly payments. Builders can offer these buydowns by paying a lump sum to the lender up front, essentially buying down the rate for the buyer.
So it's like a little financial gift from the builder to help buyers qualify for a mortgage and make those monthly payments more manageable. I can see why that would be appealing in a market where affordability is top of mind.
Exactly. And it's not just first-time buyers who are benefiting from these buydowns. Think about those move-up buyers who might be hesitant to give up their super low interest rates from a few years ago. A buydown can make that jump to a new home much more palatable.
It's all about making the numbers work. But buydowns aren't the only tool in the builder's toolbox, are they? We've also heard about price reductions and other financial incentives. What's the latest on those?
The National Association of Home Builders reports that a significant percentage of builders are offering some form of price reduction or financial incentive. We're talking about things like closing cost assistance, credits towards upgrades, or even straight up price cuts on certain homes.
So new construction is actually becoming more price competitive. That's good news for buyers who might have previously assumed new homes were out of their reach.
Precisely. The Realtor.com data shows that the price gap between new and existing homes has been shrinking, making new construction a more viable option for a wider range of buyers.
That's a significant shift. It seems like builders are really trying to adapt to the changing market dynamics and appeal to a broader spectrum of buyers. But let's not forget about the actual homes themselves. What are some of the trends we're seeing in terms of new home design and construction?
That's where things get really interesting. We're seeing a move away from, those cookie-cutter McMansions of the past, with builders now focusing on more diverse and sustainable housing options. Townhomes, for example, are experiencing a surge in popularity. They offer a more affordable entry point into homeownership, often with lower maintenance costs and a greater sense of community.
So it's not just about big, sprawling suburban homes anymore. Builders are recognizing the demand for smaller, more efficient, and community-oriented living spaces.
Exactly. And another trend we're seeing is a greater emphasis on energy efficiency and sustainability. Builders are incorporating green building practices, using eco-friendly materials, and designing homes that are more energy efficient and cost-effective to operate.
That makes sense given the rising costs of energy and the growing awareness of climate change. But what about those buyers who want the space and amenities of a single-family home, but aren't quite ready or able to purchase? Are there any options for them in the new construction market?
That's where the build-to-rent sector comes in. This is a rapidly growing segment of the market, with developers building entire communities of single-family homes specifically designed for renters.
So it's like a hybrid approach,
Yeah.
offering the benefits of renting with the space and privacy of a detached home. That's a brilliant solution for people who might be priced out of homeownership right now, or those who simply prefer the flexibility of renting.
Exactly. And it's important to note that these build-to-rent communities often come with amenities and services that you wouldn't typically find in a traditional rental complex, such as community pools, fitness centers, and even on-site property management.
It sounds like the lines between owning and renting are becoming increasingly blurred, with new options emerging to cater to a wider range of lifestyles and financial situations. But for our listeners out there, the real estate professionals on the ground, what does all this mean for their businesses? How can they leverage these trends to their advantage?
That's a great question. First and foremost, it's essential for agents to stay informed about these evolving trends in new construction. The more you know about the different builders, communities, financing options, and incentives available, the better equipped you'll be to guide your clients through this complex landscape.
So it's all about becoming a trusted advisor, not just a salesperson.
Exactly. And building strong relationships with builders and their sales teams is more important than ever. Those connections can give you access to valuable information, inventory, and opportunities that you wouldn't have otherwise.
It sounds like networking and relationship building are becoming increasingly crucial in this market. But what about agents who are working with sellers? How do these new construction trends impact their strategies?
That's an important point. Remember, those new construction incentives and price adjustments can make new homes very competitive, especially when compared to existing homes. So sellers need to be aware of this competition and be prepared to adjust their expectations accordingly.
So you're saying that sellers might need to be more flexible on price, or even consider offering incentives of their own to stand out in a market where those shiny new homes are vying for buyers' attention.
Exactly. And it's crucial to highlight the unique advantages of existing homes. Things like established neighborhoods, mature landscaping, move-in readiness, and even the potential for lower property taxes can be appealing to buyers who don't want to wait for new construction or deal with the potential hassles of a brand new home.
It's all about finding the right buyer for the right property. And sometimes that means showcasing the charming character of an older home that a new build just can't replicate. But before we wrap up this segment, I want to circle back to something we discussed earlier. Those mortgage spreads. Remember, Housing Wire suggested that if those spreads were to return to their historical norms, mortgage rates could drop even further, potentially unlocking a wave of pent-up buyer demand.
That's right. Those spreads are a key factor to watch. And recent data suggests they might be starting to ease, which could signal even lower mortgage rates in the coming months.
That would be a game changer for affordability and could really shake things up in the market. But even with those potential positive developments, there are still some wildcards out there that could impact a market in unexpected ways. In our final segment, we'll explore those wildcards, from economic uncertainty and policy changes to the ever-evolving dynamics of buyer and seller behavior. Stay tuned. Welcome back to The Wire. For the final part of our deep dive into the 2025 housing market, we've explored the cooling market, the rise of new construction, and those tantalizing whispers of potentially lower mortgage rates. Now let's tie everything together and see what it all means for you as real estate professionals navigating this ever-changing landscape.
It's like we've assembled a puzzle, with all these different pieces of data, market trends, and expert opinions. Now the challenge is to make sense of that bigger picture and anticipate what's coming next.
Exactly. And one of the biggest pieces of that puzzle is the economy. We've talked about how economic uncertainty has been driving those recent mortgage rate dips as investors seek those safer havens for their money. But what if those fears intensify? Could we see a scenario where the very thing that's making mortgages cheaper right now actually backfires and spooks buyers and sends them to the sidelines?
It's certainly a possibility. A significant economic downturn could impact job security, consumer confidence, and ultimately the willingness of buyers to take the plunge. On the flip side, if the economy stabilizes and those fears subside, we could see a resurgence in buyer demand, especially if those lower rates persist.
That's a delicate balance, almost like a seesaw with economic fears on one side and the allure of lower rates on the other. And right now, it's hard to say which side will tip the scales.
Exactly. And then we have those mortgage spreads we keep talking about. Remember, Housing Wire suggested that if spreads were to return to historical norms, mortgage rates could drop nearly a full percentage point lower than they are now.
That would be a huge boost for affordability. But what are the chances of that actually happening? Are there any signs that these spreads are starting to ease?
There are some encouraging indicators. Recent data suggests that spreads might be narrowing slightly, but it's still too early to say for sure. Keep a close eye on overall economic conditions, investor sentiment, and lending practices. If things start to look more stable and predictable, we might see those spreads shrink, bringing some much-needed relief to borrowers.
So it's a waiting game, but with the potential for a big payoff if those spreads cooperate.
Yeah.
But let's not forget about those other wild cards out there, the ones that could throw a wrench into even the most carefully crafted predictions.
Right. We're talking about things like policy changes, unexpected global events, or even shifts in consumer behavior. Those external forces can impact everything from lending practices, buyer demand, making it even harder to anticipate where the market is headed.
It's like trying to navigate a maze with moving walls. But amidst all this uncertainty, what's the one key takeaway you want our listeners to remember as they guide their clients through this unpredictable market?
I'd say the most important thing is to stay informed and be adaptable. Don't get caught up in the hype of panic. Instead, focus on understanding the underlying trends, analyzing the data, and adjusting your strategies accordingly.
So it's not about trying to time the market or make risky bets. It's about being prepared for anything and having the knowledge and flexibility to guide your clients through whatever challenges or opportunities may arise.
Exactly. And remember, knowledge is power. The more you understand about the forces shaping the market, the better equipped you'll be to make sound decisions and help your clients achieve their real estate goals.
That's a great point. And as always, communication is key. Keep your clients informed, explain the complexities of the market in a clear and concise way, and be their trusted advisor throughout the entire process.
This is where you, as real estate professionals, truly shine. Your expertise, your ability to connect with people, and your commitment to providing exceptional service are more valuable than ever in this dynamic market.
Well said. I think we've covered a lot of ground in this deep dive. We've explored the trends, analyzed the data, and debated the possibilities. And while there's still plenty of uncertainty ahead, one thing is clear. This market is ripe with opportunities for those who are willing to stay informed, adapt their strategies, and build strong relationships with their clients.
And remember, we're here to support you every step of the way. Stay tuned to The Wire for the latest insights and analysis, and never hesitate to reach out if you have questions or need guidance as you navigate this ever-evolving real estate landscape.
Thanks for joining us for this deep dive into the 2025 housing market. We'll be back next week with more insights and analysis to help you stay ahead of the curve. Until then, keep learning, keep adapting, and keep thriving in this exciting world of real estate.
If you're interested in your own personalized edition of The Wire, please visit us at thewire.fm/custom. We offer market-specific podcasts with all the latest real estate news and market analysis delivered to you weekly or monthly. Own your market with a personalized edition of The Wire, The Week in Real Estate. Thank you for listening.